Without further ado, I'd like to present my brother, Injil Muhammad.
Good afternoon. Good afternoon to the Syracuse community. It's so special to reconnect with Syracuse alum. It's extra special when you connect with Syracuse alum with CBT. Team, I want to thank you for the introduction. Rachel, I want to thank you for the invitation and your leadership. You know how to keep us together, keep us engaged. And I especially want to thank you for allowing me to speak during these particular times of uncertainty. We are absolutely in times we haven't seen before. And when you have uncertain times such as these, people tend to become very stressful. That stress leads to fear. That fear leads to worry. And when we worry, we tend to not act. And what worry does, as we all know, worry doesn't solve any problems. It actually prevents us from solving problems. So I equate it to this. I think about a soldier who's in battle, and the soldier's full of fear, and what solves that fear, relieves that soldier that fear, is going into action. So it's very important for us to understand that we have to have an action plan to figure out how to deal not only with the coronavirus situation, but to understand how to take care of our families now and in the future. Now, to the government's credit, it has opened up its checkbook to try to help us weather this storm. And believe me, we're in a serious storm. Many of you heard about the PPP loan program for small businesses. Many of you heard about the stimulus checks, either $1,200 or $2,400 or $500 per child. And you also heard about the extended unemployment benefits. All of these things are good, very good, but they're not enough. And what I want to talk to you guys today about is not so much those programs, but what do we do when those funds are exhausted? And how do we utilize the accounts that we have in a tax smart manner? But more importantly, the main thing I want to talk to us about is how do we position our families, our future, people we haven't met yet? I'm talking about grandchildren, great-grandchildren. What can we do now from a tax and investment standpoint to set them up for the future so that when they're faced with their coronavirus of their day, they'll be in a better position to deal with it, okay? You know, I was speaking to a good friend of mine about 2 weeks ago, and we were having this conversation about how to change the world. We still having these how to change the world conversations. And what was said to me is something I'm not gonna forget. And he said, if you're working on a problem that can be solved in your lifetime, you're thinking too small. And that's very profound. So what we want to do, I want us to think about not just our retirement, not just the coronavirus that's in our face now. Let's talk about what we can do for the future generations from a tax standpoint as well. So let's go in, let's just jump into it, and let's look at the agenda today. So the first part of this is that our goal is to build a tax-free legacy. That's what we're trying to do. We're utilizing the tax law, the investment rules, so that we can pass money down to generations from a tax-free standpoint. So the first thing I want to talk about is some tax planning strategies. And there are 3 golden rules that we're going to talk about when you talk about tax planning. The next area, we're going to talk about why we need to change the approach for tax planning. Most of us focus on what we can deduct. Is my mortgage deductible? Is traveling between jobs deductible? Can I deduct my cell phone? Those are good questions. But I think a bigger question is, what income can we exclude from the return? Can we create income that's not taxable? That's a bigger bang for your buck than a deduction, and we'll talk about why. COVID-19, as we mentioned, it's a problem. So the government has opened its checkbook, but they realize that there's not enough money in these programs. So they said, hey, you can tap your retirement account for this year only and take a tax-free distribution. We're going to talk about that. With that tax-free distribution, is this the right environment to do a Roth conversion? We're going to talk about the benefits of that. Anyone who follows me understand I'm a big Roth guy. I'm a big Roth guy because we don't want you paying taxes in retirement. The Roth affords you that ability. We're going to go through an example so to make it plain. And then something that's better than the Roth is you utilizing this vehicle that I'm going to talk to you about to transfer wealth to your offspring income tax-free as well as estate tax-free. So let's get into it. Tax planning golden rules. There are 3 rules. The first rule, in my opinion, is the most important rule, and that is pay taxes the lowest rate possible. Let me give you an example of that. My son is home for the summer, and we have a business, okay? I could shift some income to him if he works in my business. It has to be legitimate. Let's say, for example, he works in my office, and I pay him $12,000 for the summertime. I take a deduction at my rate. He picks up the 12 in income, but guess what? If you make up to $12,000, your tax rate is 0. So I can write him and give him a W-2. He files a tax return, but he won't have to pay tax because his income is $12,000 or less. Let's take it a step further. He's going to college in the fall. He could use some of that $12,000 to pay for tuition. He could, and potentially receive a tax credit or tax deduction for the education expense. So what we're talking about is legal. It's just that we're using tax smart strategies for money that we're already going to spend because he's working in the office, and that's one way to shift income to someone in a lower bracket. The other thing we want to talk about is shifting income to a lower rate, which we're going to talk about in terms of income, because income is taxed at different rates. The second item here is defer income into future years. And most of you would know about this and you're doing it. Here's an example. Let's say you, at your job, you make $120,000 a year and you decide to put money into a 401k. If you put $20,000 inside the 401k, you're going to be taxed on $100,000, not $120,000. So what you're doing is you're deferring that $20,000 income to a future period. They'll catch up to you, which we're going to talk about. But at this point in time, you're pushing that income to a future period. And the last is accelerating deductions. A deduction today is better than a deduction tomorrow. So let's say that we're in December and you're considering donating money to our Time Has Come Scholarship Fund. You're better off donating that money in December as opposed to waiting to January because you get a tax deduction now in 2020 versus waiting to January 2021. You can also put it on a credit card. Let's say, for example, cash is not where you want it to be at that moment. You can charge it in 20 and take the deduction, even though you pay the bill sometimes in 2021. So the point is, all tax planning is going to evolve around one of these 3 rules. So again, we want to pay income at the lowest rate, push income to another period, and take deductions now. Now, this is important. These are the current tax rates. And I mentioned to you that income is taxed at different rates. Ordinary income, capital gains income, and non-taxable income. All right, we're going to get to non-taxable income. So notice ordinary income, there's 7 rates. And ordinary income is income from your job, your business, real estate, pension, Social Security. So it's basically income that you earn with your hands, generally, all right? Is income you earn with your hand, with the exception of interest. Interest income is also ordinary income, all right? Now, capital gain income, this is income that you earn when you sell investments. Notice that there are 3 rates. One of them is 0, which is interesting. So you can sell stock and potentially pay no tax on it. We're going to talk about that. And then there's a 15% rate and there's a 20% rate. But notice that the highest rate for ordinary income is 37. The highest rate for capital gains is 20. So what the government is telling us is that when you earn money, you pay the highest rate, which is 37%. When your money earns money, you pay 20%. And in my opinion, there's 2 types of money. It's money that you earn and it's money that your money earns. So we want to move to the right. We want to move to the right and get to the point where we're talking about tax-free money. Not that we want to quit jobs, but the point is that we want to have income working for us as opposed to us working for income. Tax bracket, I know this is a lot. I'm not going to spend a lot of time here, but what we want you to understand is that there are different brackets and you need to understand what tax bracket that you're in. All right, so let's look at 2017 for a married couple. at 25%. The rates have come down, which is a good thing, and the brackets have expanded. Let me explain what I mean by that. If you look at the married, under the married on the right side, 2017, 25%. The income range is 77,000 to 156. If you look at 2020, the current rate at 24%, look at the income you can make and only pay 24%. So you can make 171 up until 326,000 and only pay 24%. So this is a good thing. We like this about the law. The rates have come down and the brackets have expanded. The key here is that the highest rate was 39.6%. Now the highest rate is 37%. Word to the wise. These rates come back January 1st, 2026. All the changes that we're going to talk about in terms of deductions are going to sunset and come back unless Congress acts. So understand your bracket. From a planning standpoint, understand what tax bracket you're in. It makes a whole lot of sense.